Well, hello everyone. Hello, my name is Stuart McPhee, and it's my pleasure to be here for this Trade Zone session for Eightcap. It's great to have your company. If you're joining me live, thank you very much for taking some time out of your busy schedule to join with me here on this afternoon. What I'm going to do, and I do have you for the entire month, what I'm going to do today is just start with a little PowerPoint presentation just to run through, I think, some important education information, just the way I see the market, what's important to me, the way I conduct my analysis, the way I look at managing risk, the way I see trading psychology and the like. I think that's an important foundation. I think it's an important starting point, because if you're going to listen to me, just in today's session, the session in 2 days' time, or throughout the month, I think it's really important that you understand the way I approach the market, and just sort of the values that I have and what's important to me in the market, how I, again, conduct my analysis and the like. So what I'll do is I'll just quickly flick to a PowerPoint presentation now. I do not intend to take too long with this. Just wanted to run through some background information again, so you just better understand me. So when you hear me speak, you understand where I'm coming from. So what I want to start with is my beliefs on strategies. So going back a little bit, when I first started trading a long time ago now, the whole idea of having a strategy didn't really enter my mind. It was really just looking at markets, looking at financial products. At that time, it was just stocks, and trying to find ways and trying to find a reason to enter a stock, to buy a stock. The whole idea of having a strategy, having a set of rules that followed certain technical analysis principles, that followed, say, trends or chart patterns, or looked at key levels, or looked at candlestick patterns, never even entered my mind. It was just, how can I have a reason to get into this stock? Why am I going to get into this stock? I really didn't know what I was doing. And so when we start to learn a little bit more about trading, we start to learn about having a strategy, having an approach that we can apply to the market with some consistency. But this raises an even bigger problem. And that bigger problem is, what do we put into that strategy? What are these rules that we use to put into our trading plan to form our trading strategy? And this has tormented people around the world for many, many years. And that is, how do we finally decide on what those set of trading rules will be that we put into our plan and then implement into the market? Now, I will spend some time later on this month talking about developing a strategy and some of the things that I think you need to use. And certainly, and I digress a little bit, one of the important things for me is identifying your time frame for trading is really important. And it's not something that is obvious to people. They really just think they should be open-minded to trading any sort of time frame. And I don't think that's the best way to trade. So even just identifying your time frame is a very important part of developing a strategy. And once you've done that, then you can put together some rules. So I will, throughout this month, I'll talk a little bit more about some of the factors, some of the things you need to think about when developing a strategy and the different components you need to put together. But more generally, I just wanted to talk about my beliefs with trading strategies. So I've got a few here that I'd like to just run through, and I will use some charts and use the platform to demonstrate some of these. Be prepared to zoom out to gain perspective. Let's have a look at a chart to start with, and we'll look here at the euro. So the euro US. And what I'm looking at here is a daily chart. And whilst we can zoom into 1 minute charts and 5 minute charts, 15, 31 hour charts and the like, even if I was to trade, and I certainly don't advise people trading on 1 minute charts, I'm not a huge fan, but even if I was to look at this 1 minute chart, I think not getting out and not zooming out and not looking at the bigger picture is to your detriment. Not understanding what is going on beyond, this 1 or 2 hours that we're looking at here, and not understanding the bigger picture. For example, on the daily chart, it provides us much better perspective on what is happening in the relationship between these two currencies, between the euro and the US dollar. It provides us a bit of perspective. So if we look back not so long ago, just a few months ago, we're noticing the resistance up here, throughout here. And more recently, we made another push to that level. Hopefully you can see my mouse okay. Resistance up here, making another push to that level, failing, and making another run and just sort of failing in the last little day or two. That provides me perspective. So when I now go and zoom in to here, and if I do trade on 1 minute charts or 5 minute charts, I have a bit more of an idea of what's going on in the bigger picture. You know, is the larger trend, is it going up? Is it going down? Is it going sideways? Is it currently belting its head up against resistance, failing to make any progress? Is it really finding a lot of support now at a key level and not likely to push any lower? I think those bigger picture situations are very important, even if you are trading in very narrow timeframes. That's just the way I see it. So I think, you know, zooming out to gain perspective is really, really important. Trade with the most obvious direction. I'm definitely a trend trader. I definitely believe in the power of trends. I'll just come back to my daily chart here, and we'll just look at perhaps something else here. We'll look at the British pound. So we can see here the British pound over the last few months has been trending up. I use a very simple moving average to help me identify that trend. Now we can talk about the current resistance. Just have a look at that price right now, if you give me a second. So right around the, just around the 128 level, maybe a fraction high, currently meeting resistance at that level. But we can say over the last few months, you know, indicated by this longer term moving average here, longer term moving average is moving higher. The price is well and truly above and remaining above that increasing moving average, which indicates the more medium term trend is up. I believe in trading with the most obvious direction. Now, your time frame for trading may not stipulate that that's the sort of trend you need to use and the moving average you need to use, but I think you need to use something. I think you should trade with the most obvious direction, simply put, following the trend. Now, there are certainly ways that people will trade not following the trend. But for those who trade regularly, you know, counter trend, like rallies against a downtrend and retracements against an uptrend, and you know, trading against the overall trend, those who do that type of trading and do it well, typically are very well prepared, are very decisive, know exactly what they're doing, and no beginner trader fits that mold, right? So someone who's starting out thinking they're going to be aggressive and trade all these counter trend moves, you're not really well suited and well prepared to trade that sort of strategy. So I really do believe following the trend, trading with the most obvious direction is the least difficult way to trade. And I'll never use that dirty 4-letter word when it comes to trading. I'll spell it out, EASY. I'll never use that word when it comes to trading because I don't think it is. But I think trading with trend is the least difficult way to trade. When developing a strategy, I don't think you should trade every single signal or every single strategy you develop. So if we have a think about this just for a moment, why do we trade? Why are we doing this? And I'll often do this in live audiences just to break the ice. I'll say, why are you here? Why are you wanting to learn more? Why are you interested in trading? And I said, I'll give you a hint. It rhymes with honey and begins with letter M. And of course, that word is money. And people laugh and they sort of shuffle awkwardly in their seat. And I say, relax, relax. Everybody, 99.9% of people are motivated by money. That's why we are doing this. So if we think about, and our primary motivation is to make money, it stands to reason that the more trades you take, the more opportunities you provide yourself to make money. And when we think about that, we think, well, we want to develop lots and lots of strategies, and we want to trade every single signal that all of those strategies provide us throughout the course of the trading day. And here I'm saying, no, don't do that at all. I'm a big believer in quality rather than quantity, quality of trades over quantity of trades every day of the week. And I also urge you to not trade every single signal, nor trade every strategy. Don't try to develop 10 strategies. Develop one in the first place and become the global expert of that strategy. You should know your strategy better than anybody else on the planet. You should be a master of your strategy. You should know it as well as anybody. You should know its in and outs. You should know exactly how it operates. That doesn't mean you'll know every single time you take a trade, yes, this will be a profit and this will be a loss, because no one knows what's going to happen in the market. But you have a feel and you have an understanding of how price reacts, how your strategy is there to take advantage of certain movements. And that's a story for another day when we talk a little bit more about technical analysis. But I believe in quality over quantity. And I also urge you to become a global expert, become the master of your strategy. Well, it seems like my time is escaping me already. I'll just move on a little bit because I do want to go and look at some charts in the session today. I'm a big believer in leaving trades alone. You are the weakest link, and it's very, very easy for traders, for people, especially inexperienced ones, to want to interfere, to want to get involved in open trades. Leave them alone. Your trading plan is there for a very good reason. It's there to protect you, there to ensure you follow the rules. It's there to ensure trades are seen to the end and seen to the end properly. Leave trades alone. You're the weakest link. Don't get involved. There's an illusion of control. I think for some people, when they stare at charts, they can say, oh, I can see what's about to happen now. It's going to go up. It's going to go down. It's very easy to be tempted to want to do things and act impulsively when you see prices. And if you're like me, you know, when I started out, and I think everybody does this, let's say you go long the Australian dollar, go long a stock, and you watch it, you stare at it for the next 10 seconds, 30 seconds, next 1 minute, next 5 minutes. And as soon as you see it go up 1 pip, 1 cent, you go, yes, I knew this was going to be the right trade. I knew this was going to go up. And then, you know, 5 minutes later, it's gone down 2 pips or 2 cents or whatever it might be. And you go, oh no, I knew I shouldn't have taken this trade. And then when it goes back up again, yes, I knew I was right. In fact, now I'm frustrated because now I feel like I should have bought more of them because I knew this was going to be the right trade. And, you know, this trade is 5 minutes old and we're already on a roller coaster of exaltation down to despair, back and forth and back and forth. Leave your trades alone. You know, we're now fortunate. We have platforms which allow us to see the trade through. We don't even have to be awake for our trades to be completed the way our trading plan intends them to be completed. I'm not a fan of short-term trading. I know trading platforms, all trading platforms allow us to vary the time frame. I always look at daily charts as a starting point. We can go down to 1 minute, you know, tick charts, 1 second, 5 minute. We can go down to really narrow time frames. I don't like the idea of running the menu, and that is looking for opportunities by looking at every single different time frame. As I hinted at earlier, I think it's really important, and I'll talk about in another session. I think it's important to identify your time frame for trading, stick with that and develop the rules in accordance with that time frame, and don't run the menu. You may want to look at another 1 or 2 different time frames or periodicities for perspective. Remember I said before about zooming out to gain perspective, but I don't think you should be doing it to look for more trading opportunities. Good trades take time to pay off. Be prepared. Just want to go back to the short-term trading, you know, trading 1 second, 1 minute charts. I'm not saying it's impossible. I'm just saying it's extraordinarily difficult. And the joke I often make, but there's always a bit of truth behind every joke, right? The joke I often make is I think sometimes you'll have a better chance going to the casino and making money than trading 1 minute charts. The lack of logic, the lack of flow with what happens from this minute to the next block of 60 seconds to what happens to the next block of 60 seconds, there's no logical flow behind that. You know, if I look at a daily chart of the British pound here, I can see a flow. I can see a logic. I can see a trend. I can see, you know, pushing through previous highs, retracing, retesting those new highs. You know, here I can see a lot of resistance, you know, a couple of dojis there, or 3 dojis, sort of some tweezer top, hammerhead type patterns there. That tells me something about the interaction between buyers and sellers. There's a logic there. There's a flow that I can understand. Now, I won't be able to predict that or forecast what will happen all the time, 100% guaranteed, but I can assess some probability of what is likely to happen next beyond that period of time. Once I see all that resistance at that particular level, I then see that resistance then become a level of support over here some time later. That tells me something. Using my technical analysis, I can look at that and make observations on that and develop rules based on that. Can we do that with a 1 minute chart? Maybe. I'm not a believer. I don't think you can. If you want to prove me wrong, by all means, knock yourself out. It's just not been my experience. You know, I don't hear a lot of people coming to me and saying, I'm trading really, really well and I'm trading on 1 minute charts. I just don't have those conversations with people. What I do have is I'm trading well. I've really slowed down my trading a lot. I'm not trading on 1 hour charts anymore. I'm more looking at 4 hour charts, daily charts. I love how everything slows down a little bit more. My time horizon's broader, longer, et cetera, et cetera. Anyway, that's just been my experience over the years. And I'll just finish off on this because I really need to move on and show you some charts as I just check the time there. I do believe in gaining an edge. That's going to be your trading system, your trading strategy, developing those set of rules that you know with confidence you can put in. It gives you an edge. We'll talk about that during another session later on this month. Believe in your edge and have that confidence in yourself and your own ability, but obviously the strategy that you put together to implement into the market. Cannot overstate the importance of having the discipline, the level of self-control to ensure you do all the right things and do them well, do them to the best of your ability and do them correctly. And I will talk about this again another time as well. I cannot overstate the importance of simplicity and keeping your trading approach simple. You may know if you've read anything about me, read my bio or anything, I do have a book that was published now more than 20 years ago. It has had subsequent editions released, published now in its fourth edition. Whenever I've sold a book to someone, been at a live presentation and handed over a book to someone, I've always signed that book if they've wanted me to do so. And before my signature, I always, and I'd like to think some people listening in will have a book that has these very words in the front cover. I've always written before my signature, keep it simple. Keep it simple. I really value that idea. I'll come back to that, talk about that another time. Need to move on. I'll just finish on this. I do have a few more slides, but I'll finish on this. It's really, really important you develop a plan that's right for you, resonates with you, very, very comfortable with you, and then implement that with the right mindset. We'll talk about this in more detail throughout this month. We'll talk about the 3 M's over there on the right-hand side, managing your risk or your money, the methodology, the system, the strategy, the set of rules to get you into trades, and of course, the glue that keeps it all together, underpins it all, and ultimately determines whether you are successful or not. And that is the 6 inches in between your ears, and that is your mind and your psychology. Let's go and have a look at a few charts. We'll just come back to, I'll start with the Australian dollar. Yes, I am Australian, not for any reason that I would select the Australian dollar. I do look at it every day, but I'll just start with this just for a little bit. And one of the things that I found with this, certainly with a few currencies now, but certainly the Australian dollar, and I could throw in the ASX 200 as well for those who do trade indices, and that is how frustrating some of these have been. Sorry, I zoomed out too far there. How frustrating some of these things have been. Now, I've gone back a fair amount of time there, almost 2 months with the ASX 200, and the ASX 200 has pretty much remained within I would call a relatively narrow range, and it is narrow because it's less than 10%. Now, that's just my sort of rule of thumb. It's pretty much spent, I would argue, certainly more than 70%, maybe 75 to 80% without doing the numbers, of its time over the last 2 years remaining within that narrow range of 10% or less. Now, what that does is provides a lot of frustration to people, because what it does is provides for a lot of people limited trading opportunities. Now, the Australian dollar has done something quite similar, and what I could draw in some key levels here, I'll just go to sort of 66 cents as a start, right around there somewhere. So we can see over the last few months, found a lot of support at that 66 cents level. It has dropped down below. And, if you're looking back here, right-hand edge of screen, sorry, if we were looking here, right-hand edge of screen, we're thinking, sorry, just get rid of those few green candles there. We're looking, wow, this, we're trading now at a 6-month low. This is definitely heading back down to these previous levels here, down near 62 cents. It didn't happen that way. Very quickly rallied back up. Nice doji candlestick there. Just zoom in a little bit there for you. Nice doji candlestick at the bottom, and able to, push back up, back below, back above 66 cents, back up to around the 68 cent level. So if I draw in a more narrow sort of here, that's roughly 68 cents. You'll just quickly make that nice and precise for you. So that's right around the 68 cent level. And again, similar to the ASX 200, although we're looking at a much larger time frame over 2 years and a range of less than 10%. Even this currency pair here in the last 3 or 4 months has spent most of its time trading within a relatively narrow range. Now, for a lot of people, 200 pips is enough. Now, remember, you're not going to trade to the extremes. What I mean by that is it's very well and good for us to look back now and go, oh, look at this. It's moved from 66 up to 68, back to 66, up to 68, back and forth, back and forth. That's 200 pips. Well, I can make a lot of money from that. I'll trade, X trade size, that's X dollars per pip profit, 200 pips. The reality is you're not going to trade, you're not going to pick, you're not going to get the maximum 200 pips out of that. If you are, and some people will, then you've been doing this a long time and do it very, very well. For most people, they're not going to do that. They're not going to probably see out the trade. They're probably going to, let's say you did get at the bottom here. Two weeks later, it's now 150 pips up. You're probably going to take it, or it's going to retrace so much, it's going to take out your stop. You're not going to see that 200 pip gain, and then you're going to go short because you think, right, it's on its way down again, but sure enough, it continues the rally and moves up to that 68 cents level. It's just really tough, especially when you don't have rules. It's really tough to be able to time it that well. So it's very easy to look back in hindsight and look, wow, look at all those opportunities. But for a lot of people, this is really congested. And the moving averages in the middle here, the blue and the red, the fact that they're flat for a lot of that time, I'll just zoom in a little bit more for you. The fact that they're flat for a lot of this time here, I've just zoomed in a little bit too much there. Flat for a lot of this time, just looking at these moving averages here, yes, they start to sort of move with purpose here, and certainly here and here again. But even now, they're starting to converge and come back together and tighten up a little bit. We've got that longer term moving average as well, which is the black line, which, yes, it started to come down after this massive fall here, but it's really starting to flatten out now. So when we see the longer term moving average quite flat, we see the shorter term moving averages flat. What's that telling me? Not a lot of movement, especially when the longer term average, the black line there, is really starting to flatten out, because it takes a lot of convincing. It's there for a very good reason. It takes a lot of convincing that, yes, this is the trend, or in fact, we are really quite flattening out now. That doesn't provide opportunity for people. So what we're seeing now, even in the last couple of weeks, we're seeing again another bounce off that 66 cent level. Does that mean it's springing back up to 68 again? Maybe. And if it does, well, you know what? There's a very good chance it's going to get to that level and stop again. Why? Because people have seen what happened recently, ignoring this outlier, because once it got through here, nice reversal at the top and very quickly got smashed. Some big red candles through here, moving it all the way back. Wouldn't you agree? So yeah, it got through 68. Sorry, I need to come to recent time. Got through 68, far right-hand of your screen, got through 68 really, really strongly. And like down here, we're going, wow, look at this 6-month low. Now we're going, wow, look at 3 or 4 month high. And it just got smashed. It got rejected really, really quickly. Nice little doji here, indicating weakness in the prevailing trend. And very quickly, 1, 2 strong red days. And then we've got 1, 2, 3, 4, 5 of the next 6 days being red. And very quickly, it got slammed. This is probably the biggest day in that lot. And the second biggest day, equal with this one here, smashing about down to 68, 66. So it's smashed through, thinking, right, we're on our way now, and it just got smashed back. What does that tell me when it gets back up to 68 again? Not a lot of people are keen to see it above 68. There's a lot of pressure there wanting to sell it at 68 or thereabouts, or certainly above. So what happens then, and the fact that it happened here, rejected, rejected, rejected. Yes, it broke through, but quickly rejected again. What happens now? If it returns to 68 again, and if enough people look at this and go, wow, look what happened when it got to 68 recently in the last few months, it got sold off really, really quickly. Some big red days here. That's a big rejection. And again, 2 big red candles in a row there. It gets sold off. So if I'm buying it down here and it starts to move high and it starts to get towards 68, do I want to buy more? Definitely not. Do I want to sell? Maybe. I certainly maybe want to unload a little bit, but I'm getting very close to wanting to sell. If it is now up near 68 cents, do I want to buy? Let's say I'm not in the Australian dollar. Do I want to buy? No way. It's not likely to go much higher than this, because it's going to hit that 68 level and get pushed back down again. I'm not wanting to buy. So we've got diminished demand. Let's say, do I want to sell? Well, I'm not in the Australian dollar. Do I want to sell? Yeah, I'm actually looking to sell it and see if I can push it back down and see it ride back down to 66 cents. Whichever one of those situations is you, we've got a massive extreme. We have a massive shift from, diminished demand, increased supply. People who own it want to sell it. People don't want to buy it. We just get this massive shift to selling. And so all of a sudden we have supply overwhelm demand. Guess what that means? That means prices fall. Why? Because people have observed what has happened previously. The interesting thing about this, what we're seeing with the Australian dollar, and I did actually just have a look at this before I knew this, but I wanted to see it. So I'm currently on the side of the Reserve Bank of Australia, Australia's central bank. And you'll see here going back over the last 18 months or so, the target rate, the RBA cash rate, and what they have increased at each of their monthly meetings. And there's never a meeting in January. Therefore, there's a gap here. But what we've seen is they sat last week and didn't actually raise rates, but 12 of the previous 13 meetings, they actually increased rates. And we know one of the largest factors determining currency rates between two currencies is the difference in interest rates, and interest rates is probably the biggest factor. And here we have the Australian Central Bank raising rates 12 times in 13 meetings, having just sat last week, clearly increasing the cash rate, clearly increasing the appetite for the Australian dollar, but we just have not seen that happen in the Australian dollar, because what's the Fed been doing as well? Of course, they've been raising rates as well and are likely to do so again this month. And just like Australia's central bank are also talking about into the future and likely plans of, September and then maybe another one by November, et cetera, et cetera. So we're not seeing that separation. Therefore, we're not seeing great appetite for the Australian dollar. It's just not happening. And what we see right now is this band, this range between 66 and 68 cents, and it's really struggling to get through. If I look on another side, look at another currency up against the US dollar, the British pound presents a different picture. I always like to zoom out for perspective. I know I can't trade back here, I know that, but I do like to zoom out for perspective. And what we have seen in the last, almost 12 months is just a great steady increase. Now, admittedly, right this very second, we are seeing, pretty significant resistance right around, we'll just call that 128. If I just draw that in there, 128. I do like to be precise, so I'll make sure that is right at 128. And we can see there just a few weeks ago, pushing up through that level, quickly sold. A lot of uncertainty, some doji candlesticks here, another test again and rejected. And that's okay. It came back to this previous level through here where it was previously resisted, now finds support. We like resistance. If broken, which it was through here, then becomes a level of support and pushes back up. But again, we've found this level here at 128, providing a lot of resistance. So again, imagine this falling away again, testing again, falling away again, and testing again and falling away again. The more times this happens over a sort of period of time, confined period of time, the more significant that level becomes. And the more likelihood that level is, it becomes self-fulfilling. And I can assure you now, there's nothing the Bank of England is saying or the Fed's saying which says, you know what, the British pound is not worth $1.30. It's not worth it. They're not saying that at all. What we are seeing is just the behaviour of people and people reacting based on previous price action and seeing this resistance at at 128 and self-fulfilling. It's funny, technical analysis, self-fulfilling. I'll just go back to the euro just for a second again. And again, I just like to zoom out for perspective. Slightly different picture to the pound, but similar, appreciated well over the last, certainly, 9 months or so, but a little bit flatter at the top. Whereas with the British pound, we've seen a nice steady increase over the last, the last few months or so. The euro has been a little bit flatter. And again, if we just look at these key levels, and we're looking at the top here at probably $1.08 or thereabouts. I take that back, $1.10, right at that level there. I won't draw that precisely. $1.10, like $1, is a nice round number. We can see how price reacted here. Again, it's pushed through, sold off very quickly, hung around that level for 2 weeks, but never really made any significant gains beyond that level. Again, we're seeing resistance, and then we see it sold off, making another run. Guess where it gets to here? $1.10 gets sold off again. So again, we're seeing a cap on a lot of these major currency pairs. The Australian dollar, well, it's not near 68, but if it was to move there, we'd see that cap there. $1.28 British pound, $1.10 with the euro. We're seeing this sort of significant resistance just remaining in place there, really stunting any sort of potential gains there, adding to this congestion and sideways trading, which unfortunately can frustrate people. That's just what happens when we are denied our trading opportunities. Well, there's my 30 minutes gone very, very quickly. Unfortunately, it does go quickly when I'm having fun anyway, when I'm talking about stuff that I love talking about, and the time goes very quickly. Fortunately for me, I have additional sessions with you throughout this week, and I'll be joining you again in 48 hours. This Wednesday, when I'll be talking about a few other things, we'll actually recap some of these currency pairs. We'll look at gold and a few other indices and see what they've done in the last 48 hours. But until then, I hope that has provided you some food for thought. Hopefully it's provided you a different perspective on how people can approach the market, including myself. I look forward to seeing you again in future sessions this month, and we can share this journey as we go through and look at some trading opportunities and look at strategies and the like through the month. Until then, all the very best with your trading, and I look forward to speaking with you again soon. Thanks very much.